Hello, everyone, and thank you so much for taking the time to learn about the financial GPS. My name is Joni Hyde, and my goal is to give you a high-level overview of this incredible program and what it's able to do for our clients. Our company mission and ministry is to buy back America one family at a time, simultaneously converting debt to wealth by putting the bank's secrets into the hands of our clients and professional partners. And we are so glad to have you on this meeting. What I'm talking to you about today is the award-winning program in financial GPS technology that can assist you in eliminating any and all debt, including mortgages, credit cards, student loans, and auto loans in as little as 1/3 the time of the bank's plan, without any change in your budget, without loan consolidation, without refinancing again, and without any negative impact in your lifestyle or budget. It can save you tens to hundreds of thousands of dollars of interest in the process and redirect those dollars back into your pocket, helping you gain equity faster, along with being a personal digital financial advisor for a lifetime. Our program is individualized and designed to give people hope and put families in a better financial situation so they can build a legacy for their family rather than for the bank, which is what we've been doing for the last few generations. This is not a concept or theory. This is math. So results are guaranteed. And we have a 17-year proven history of giving families a new financial trajectory for themselves. We know the banks have had this technology for years, but technology has finally caught up with personal finance with the world's first and only financial GPS. It makes complicated decisions for you, always working toward the most strategic mathematical solution to every scenario, and works to zero out as much interest as possible, building equity faster. It keeps you focused and tracks your success. So every time you log into your dashboard, which I will show you, it displays how much you saved in interest in time and in time. It has the power to forecast the cost of future decisions. It always gives you the best, most strategic decision for your family. It always shows you your debt-free date, and there's absolutely nothing else, excuse me, like this fantastic program that will show you how to create arbitrage in your own personal finances and win at the bank's game. Before we get into a demonstration for today, I'd like to quickly share so you understand a little bit about our company and how we began. The first generation of the program was launched in the early 2000s, and it was the result of two owners of one of the fastest growing mortgage companies coming together. And these gentlemen quickly identified a problem for their clients as they noticed year after year, people would get their mortgages and then they would come back either deeper in debt, using their home as virtually an ATM, or they would refinance and just kick the can down the road, maybe save themselves a few $100s, but reset that debt clock and refront load the interest. And it was great for their mortgage business, but they realized it wasn't great for their clients because they weren't gaining equity in their homes. So they started looking for a solution and found a program that was being used overseas that was developed by Richard Branson. And Richard Branson actually partnered with the Royal Bank of Scotland on this project, and it was called the One Account. And on that program, homeowners were paying tens of thousands of dollars less in interest than what we were doing as Americans with the same interest rate. These gentlemen were intrigued, to say the least, so they took a deeper look into understanding the financial principles incorporated into the program. And they consulted with IT experts, engineers, and mathematicians, and came up with the first generation of this award-winning program, which was launched in 2004. But this first generation of our program was modeled after the One Account, and that was a mortgage product. So this program only was able to help homeowners, and it did require that they had good credit and enough equity in their home so they could apply for and qualify for a first position line of credit. So there were some obvious challenges back when we first launched our company, but that was the first generation of this program, and it's come a long way since. Also back then, there was a lack of technology issue, so it was difficult for people to manage what the program offered to the degree that we can now. In spite of those challenges, we were nominated by Wells Fargo Bank and were presented with the Ernst & Young Entrepreneur of the Year Award in 2008. And this was for the financial services division. And if you know anything about Ernst & Young, you know they do very intense due diligence of their nominees. This same recognition has been awarded to very impactful companies such as Apple, Starbucks, eBay, and Microsoft. So we are very grateful and honored to be in category of recipient. We have also been featured in multiple industry magazines, and we have an A+ rating with the Better Business Bureau. We offer a money-back guarantee because we are absolutely confident in the results that we promise our clients. Now, continuing on, in 2008, we had the global financial meltdown, and many of you probably remember what happened back then. So remember, the first generation of this program required a line of credit to power the algorithm. Around the time of the crash, banks started pulling equity lines of credit and not issuing new lines of credit. So basically, in regards to this program, it was like having a Ferrari with no wheels because we needed that equity line of credit to power the algorithm. So the owners of the company resolved that they would find an alternative, another option for clients. So they continued to improve the technology while servicing their existing clients. They poured a total of $19 million in research and development into further refining the solution to make the technology what it is today. And it turned out to be a blessing in disguise for this initiative because it prompted the need to create a product that did not have a reliance on a home equity line of credit or any other line of credit. And that was what they created. And once the algorithms were perfected, the new updates were released in 2019. And this was a huge accomplishment because now we can help anybody with any kind of debt. You don't have to have a mortgage, or if you have a mortgage, you don't have to have equity in it. You don't even have to have good credit. And we also are releasing our pro version, which we'll talk about more at another time. Moving on, we're going to dive into some numbers. Now, these next few slides are just a little education. I'm not picking on mortgages, but I want to bring to your attention how tricky some banking products are, because when we see 4%, it's not really 4%. So this program can help anyone who has any kind of debt, but this is an eye-opener on mortgages. And often when we speak with folks and present them with the opportunity to have their complementary savings analysis done, that will make more sense to you in a moment. One of the first questions we ask them is, tell us about what kind of debt you have. And many say, I don't have any debt, I only have a mortgage. So we as a society are trained to not think of a mortgage as debt, but it's our greatest robber of wealth because of the way the interest is calculated on a closed-end loan, also known as the mortgage. And a little history about mortgages. Prior to the Great Depression, mortgages used to be simple interest loans and banks required 80% down. So folks were only financing 20%. Also, the lengths of those loans were very short. They were about 5 to 7 years. But once the Great Depression hit, mortgages have never been the same. The feds passed legislation called the New Deal. And that legislation was meant to help more families get into homes. And it was designed to counteract all the problems that rose out of the Great Depression and create a more consumer-friendly nation. But this same legislation actually gave the banks some new amortization guidelines and rules that, quite frankly, have taken a lot of generational wealth away from families these last few generations and are transferring it right into the hands of the banks. For example, look at the amortization of this $300,000 mortgage with an interest rate of 4%. And you'll notice in year one, you're actually paying a volume of interest of 69.26% on a 4% mortgage. Year five, you're still paying 63.94% volume. Year 10, you're at 55.97. Year 15, you're at 46.24. And if you follow this loan to its end, you'll have paid in $217,254 of interest, which is 72% interest volume on a 4% mortgage. It's absolutely ludicrous And there is a better way. We need our mortgages, we need our lenders, but what we want to introduce you to is a better way, because we are on a mission to end the bondage of debt enslavement. Now, again, not picking on mortgages, but just looking a little more closely at that same amortization so you can wrap your head around how tricky banking products can be. Their monthly payment on that loan was $1,432.25. And in month one, when we make our first payment, notice only $432.25 goes to principal and $1,000 goes to interest. That means in the first payment, 70% of our money is going towards interest. And look at what happens in month two. Their principal contribution is now $433.69. So we increased our principal contribution by a whopping $1.44. And there's no wonder it takes 30 years to pay off this type of loan. Now let's look at year one, and I want you to start concentrating on that. The last two columns that say equity and paid. And at the end of year one, I've paid in a total of $17,187 to the financial institution. But my equity position is only $4,835. Now look at year five. This is a real eye opener. We've paid in $85,935. Our equity position is only $28,132. $57,803 has just been tipped to the bank as interest. That's just in 5 years. By the time we move into year 10, we've paid in a total of $171,870, but our equity position is only $63,006. By year 19, we finally paid in a total of $326,553. Our equity position is $146,335. And we are just now getting close to the halfway mark on that loan, because we still have $153,665 left on the $300,000 mortgage. And if we carry this loan out all the way out to the end, we find that on that $300,000 loan, we're paying back a total of $515,608, and that the true interest charges we paid over the course of that loan is 72%. And that should make you look at your mortgage a little bit differently than you did yesterday. And now I realize that interest rates may be a little lower now. And I talked to a lot of people recently who have a 2.75 or 3% interest rate, but you're still paying $155,332 on a 3% mortgage, which is 52% interest volume. All right, so we are going to completely switch gears and stop picking on mortgages. And I want to move into our example of what I want you to see today. And your situation and your results will be very different than this sample, John and Rebecca Jones client. And what I want to do is just use them as a sample. So John and Rebecca Jones came to one of us as agents, representatives for this financial GPS, and asked if they could have a complimentary savings analysis meeting. We meet over Zoom, husband and wife, if there's two, if it's a single person, just one, and we see what this program can do for them. So here's a snapshot of what John and Rebecca Jones' situation looks like. Their total monthly income is $5,000. They spend $4,800 a month on debts and expenses. That includes shopping, going to dinner, investing, anything you can think of. And after that, after everything is taken care of, on an average month, they have $200 of discretionary left over. And our typical client has in the range of $100 to $300 left over at the end of the month as discretionary. But the program works fabulously, even with a smaller discretionary. And of course, the program can be turbocharged even more with a larger discretionary budget. John and Rebecca Jones have that $300,000 mortgage that we were talking about at 4%. The payment is $1,432 a month. They also have a car loan with an $18,907 balance. And in this case, they have a credit card with no current balance. They charge all of their expenses throughout the month and pay it off before the interest is due, just like a lot of other smart folks out there listening. So I'm going to break away from this screen share and bring you over and show you what John and Rebecca's savings analysis report looks like. So let me find my screen share again and bring you over. And you'll notice that we have their mortgage, their car loan, credit card with a balance of $1. Total debt they're managing right now is $318,908. And we've got their income of $5,000, their debts, their expenses, and that leaves $200 discretionary left over, as we discussed. So here is what the program will do for them with just $200 of discretionary a month. And you'll see in red here on the bank's plan, let me draw your eye down to where I'm circling around. On the bank's plan, they would be repaying $217,309 of interest on that mortgage and car loan if they followed the bank's plan. By simply following the plan of this financial GPS, we will take that number down to $96,759. They would need an interest rate of 1.85% on all of their debt combined to pay this little interest. The program is going to save them $120,550 of interest. That is a 55% in savings in interest on what the bank wanted them to pay back. But not only that, the program is going to save them 16.3 years of payments. They will have their mortgage and their car paid off in 13.7 years. They could not have even achieved that if they refinanced for 15 years. Moving down even a little further, I want to show you their amortization schedule, and you'll see in red is the bank's plan. And I want you to, for example, look at year 10. On the bank's plan, they would owe $236,351. On this plan, just following this financial GPS and allowing the program to tell them where to put that approximately $200 a month, where to pay it, and so forth, they would owe only $105,000 on this same loan. They would be over $100,000 ahead. So let's say John and Rebecca decide to sell their home in 10 years. They'll have so much more equity in that loan and so much more cash in their pocket if they were to sell that home. Moving on a little further down, I want to draw your eye down to where you start seeing the green. So John and Rebecca on our plan, following the financial GPS, will be debt-free in 13.7 years. And we show a scenario just showing the client how much the banks are truly taking from us as far as our generational wealth. What if John and Rebecca were to take those payments that they otherwise would have been paying the banks for those additional years and put it in a 1% compounding investment vehicle? And this is how their money would be compounding over the course of those years that they otherwise would have just been paying off their mortgage. And you'll see it's over $500,000. And we have better options for folks than that, but we just want to show you it with a simple scenario of a 1% situation, how much money will compound for you in the future if you don't follow the bank's plan, because this is their plan to keep you in the enslavement of debt for the rest of your life. So let me go ahead and stop that screen share. And I want to take you over and show you a sample of what John and Rebecca Jones financial GPS looks like. We set this up for the client. And so I created a demonstration account for John and Rebecca Jones. And you'll see right out of the gate, they have 13.7 years to pay everything off. And the potential interest savings is $120,675 right out of the gate. We build this program for the client, and we have professional coaching available for the lifetime of owning the product. So you'll see on the accounts tab, we've got their car loan entered in, $18,907. the MasterCard with a zero balance, and the first mortgage fresh out of the gate with $300,000 balance on it. I want to take you and show you the budget tab. Now, we also build out the client's budget for them. You'll see John and Rebecca have $5,000 of income. John's is $1,300 a month. Rebecca is $24,000. Sorry, John's is semi-monthly. Rebecca's is $2,400 a month. And then we also build the expense budget out for the clients. Some clients, like John and Rebecca Jones, like to just keep everything broad view. We've dialed in on their food and dining and their bills and utilities, and they have everything else in an everything else category. Some folks like to keep it broad and not micromanage themselves, but we have the ability to create and build out a budget with John and Rebecca Jones and really dial in and micromanage everything as closely as they would like, which some of our clients like to do that. They actually kind of model it after the envelope system and really see where every penny is going. We build this out with you the way that works best for you. So let's go over and look at the action plan. So the action plan is the client's 90-day to-do list. And the action plan is information aggregated over from the accounts tab and the budget tab. So it builds out a 90-day to-do list. And when you see these double red arrows, this is the teeth of the program suggesting, making a suggested funds transfer to John and Rebecca Jones saying, if you do this, then you will stay on track to be debt-free in 13.7 years with a potential interest savings of $120,675. And as John and Rebecca move through time, telling the program what actually happened, let's say, for example, John only got $1,200. We'll say he's on commission and will execute this action. And when you execute actions, it affects what's going on and things change over their future. So let me show you a few examples of the real power of this financial GPS and give you a scenario with John and Rebecca Jones. They're very happy in their current situation. They're going to have this 30-year mortgage paid off and the car in 13.7 years. So they want to put an impromptu vacation on their action plan, but they don't actually have money saved up for that. So they're going to have to put it on their MasterCard, and they're going to let this program tell them what the implications are of making that decision before they actually pull the trigger on that. And so they're going to take a $2,000 vacation, and they're going to tell the program it's travel, it's vacation. There's a very robust reporting feature that you can utilize with this program, and they're going to save it to their action plan. And starting out, our potential interest savings is $120,603. Our time to get out of debt is 13.7 years. Let's see what this will do to this scenario when we add that impromptu vacation. All right, so it's going to change the potential interest savings from $120,603 to $116,424. And it's going to increase their years to pay off from 13.7 to 13.9. But John and Rebecca are thrilled with that, and they're going to go for it on their vacation. And you'll see this is on their action plan. If they decided that they didn't want to take the vacation, they could delete it from their action plan. If they take the vacation, they will execute their action plan. And we also have the option of showing the true cost. If you really want to see the overall impact of what your decisions are making, your plans are going to have an impact on your future before you actually follow through with that plan. So you'll see the true cost of the opportunity and the long-term impact of taking that vacation and spending that extra $2,000 is $6,955 over the course of the next 13.9 years. But John and Rebecca Jones can live with that. So we'll turn true cost off, and I want to show you a couple other things. So John got some good news. He's getting a $1 an hour raise. And so that's $80 a paycheck. And John and Rebecca Jones are really gamifying the whole process of becoming debt-free now that they have this program and can see the cause and effect of every decision before they even really pull the trigger on it. But in this scenario, they are not adding any additional expenses at the moment. So they're going to tell the program, use all this discretionary to further eliminate interest and get us to that debt-free point as fast as possible. So we're going to save this to the action plan, and we'll see how that changes the results on their dashboard. So now John and Rebecca Jones, their potential interest savings went up from $116,424 to $124,586. And their years to pay off went down from 13.9 years to 12.8. So they just shaved 1 year and 1 month off their mortgage with that $1 raise that John received. So hopefully that shows you the impact of really looking at letting this program guide you with any discretionary funds that you have. Now, let's start thinking a little bigger here, because this program is not just for the John and Rebecca Jones of the world who only have a few $100s of discretionary. This program is also fantastic for the investors and the investor-minded folks. And the program can handle up to 99 mortgages at one time. So let's add another mortgage into the mix. And let's just say John and Rebecca Jones, the father gave them money for a down payment. So they simply need to get a renter in the property and make sure that mortgage is covered every month. So I'm going to add in a scenario here where we need to go over to the accounts tab and add in a new account. And we're going to add in a mortgage. John and Rebecca talked to their mortgage broker and their realtor, and they have found that they can pick up a nice rental property for $200,000. And the rate is going to be 3%. And we're going to finance that for 30 years. And the payment amount for that will be $843.21. We're also going to tell the program that their escrows are $500 a month. And they're going to purchase this property immediately. So we'll put that on the last day of September, and we'll save that to the action plan. Again, they're not having to come up with a down payment. We just want to see if having a renter in that property will make sense for them and how that will change the whole plan. So we're going to save that to their action plan, and we're going to then account for the rental income, and we simply add another income. That's going to be our rental income. And the program again lets us tell it very distinctly where that money is coming from. And we're just going to cover the mortgage and the escrow with a few dollars left over. Now we want to be very practical because John needs a few months to work on the property. So they're going to start renting it January of 2022. Save that to our action plan, and we'll see how the program will help them manage. John and Rebecca Jones, who previously were going to have their mortgage paid off in 30 years, brought that down to 13.9 years, and now are able to have 2 properties paid off in 15.5 years and a potential interest savings of $161,827 by following this financial GPS. All right, let's head back over and just kind of look at a summary of what we're able to accomplish for John and Rebecca Jones compared to the bank's plan. And in the column labeled conventional mortgage, you will see on the bank's plan with this $300,000 conventional mortgage, it would take 30 years of payments plus an additional $217,309 of interest to pay off this loan. By following this financial GPS, they compress the payoff time of this $300,000 mortgage to 13.7 years. And remember, that included their $18,000 car loan too. And they reduced the amount of interest paid to $96,759. So they canceled $120,550 of interest that would have been paid to the bank and redirected it back into their pocket for opportunities for their family, while shaving 16.3 years off. That's 161 mortgage payments that they shaved off their timeline. And they also accelerated their equity position by over 50% and reduced their effective interest rate to 1.85%. And that is a life-changing scenario for a regular couple. This program truly gives our clients the power to bank like a bank. It's always calculating the optimal time to leverage money to gain equity faster and cancel interest. It's a very complex 26-page program with millions of lines of code and thousands of algorithms constantly recalibrating and recalculating the most effective use of every dollar you have flowing in and out of your household. Banks have done this for many years, and now the power is in the hands of the consumer. And the reason why we call this financial GPS is because just like GPS navigation on your phones, our financial GPS will always find the most strategic way to reduce the effective interest rate on all of your debts. Also, it recalibrates constantly as you move through time, always analyzing your unique situation because your situation will change. And do you have multiple streams of income? Are you paid weekly or biweekly or monthly? Are you commission-based? This program works fabulously and flawlessly in all of those situations. It looks at the amount you owe on each debt, the terms, how the interest is calculated, how the minimum payments are calculated, and when they are due. It factors in the interest rates and the type of banking product it is, because each banking product calculates interest differently. It anticipates future expenses, and no other program or spreadsheet on the market works like a GPS to course correct you. Our financial GPS starts out leading you, but as those unplanned events occur, it will course correct you, and that's when the program begins to follow you, getting you back on track. I want you to understand what this program does not do. It does not move money or pay bills for you. We don't need to ever know your account numbers, and we never access your bank accounts. It's just like an account register or a mirror of what you have going on in your life. Once it's set up, you log in and reconcile with the program what you actually made and spent versus what we told the program to expect. It's very, very easy to update, and it's going to keep you on track completely and give you hope and a better future financially in as little as 20 minutes a month of engagement. All right, so in summary, this program, this financial GPS, helps compress debt payoff to a fraction of the time, helps you gain equity 50 to 75% faster than the bank's plan, and saves you tens of thousands of dollars of interest and redirects it back into your pocket in the process, drastically reducing the effective interest rate on any debts that you carry for the rest of your life, helps you make educated financial decisions before you actually pull the trigger on those decisions. And in many cases, it improves credit scores because as you lower your debt to income ratio, credit scores tend to improve. You own the program for life, and you can use it on current debts and future home purchases. There are no mandatory monthly fees, no contracts, no surprises, and there are free updates of new versions. We have professional coaches that set the program up for you and teach you how to use it. And we have lifetime professional coaching and customer support. We have a money back guarantee because our results are math, and math works. So for the rest of the story, I'd love to offer a complimentary, no obligation savings analysis meeting to anyone with a mortgage or any other kind of debt. These 1-hour meetings are done on Zoom, which makes it very easy for everyone. From that analysis, you will find out the exact month and year that you could be debt-free, in addition to exactly how many tens of thousands of dollars of interest you'd be saving along the way. So for your next step, please get back with the person who invited you to watch this webinar, or if I invited you, please text me and let me know that you or you and your spouse, if there's 2 adults in the household, we need both on board and looking at this information and present for the Zoom meetings. And let us know that you watched this session and that you would like one of 2 things. You would like either, number 1, to set up a 15-minute phone consultation to just get to know you a little bit and talk a little bit about your situation to move in the direction of getting a savings analysis done. Or if you are ready, let us know that, and we can work to schedule a 1-hour complimentary savings analysis over Zoom. I look forward to hearing from you. And remember, the numbers will tell the whole story. If I invited you to watch this webinar, please contact me. I prefer text. Text me your first name and last name and let me know if you'd like to have a 15-minute consultation or if you would like to schedule your complimentary savings analysis. And if it wasn't me who invited you to watch this, please get back to the person who invited you, who can also help you and will help you work through this process and meet with you for either that 15-minute consultation or to get your complimentary savings analysis set up. Thank you so much. This is just a snippet of what the program can do, and we look forward to meeting with you.